Welcome back to Wealth Investopia. Today, we're delving into a fascinating and influential topic that straddles the worlds of finance and corporate governance: hedge fund activism. This phenomenon has become a significant force over the past few decades, reshaping how companies operate and how they interact with their shareholders. But what exactly is hedge fund activism, and what are its implications for the companies involved and their shareholders? Let's explore this multifaceted topic in depth. What is hedge fund activism? Hedge fund activism is a strategy employed by hedge funds to influence a company's management and policies. The ultimate goal is to increase shareholder value, and activists achieve this by pushing for various changes within a company. These changes can range from advocating for shifts in management to suggesting operational restructuring, or even recommending that companies return excess cash to shareholders through dividends or share buybacks. Activist investors typically acquire significant stakes in publicly traded companies to gain enough influence to drive the changes they deem necessary. Prominent activist investors include firms like Elliott Management, Carl Icahn Enterprises, and Third Point, among others. These investors are known for their strategic approach and ability to make substantial impacts on the companies they target. In recent years, the frequency and scale of activism campaigns have surged dramatically. To put this in perspective, the number of high-profile campaigns targeted at Fortune 500 companies has tripled since 2000. The stakes involved in these campaigns are enormous, as they often affect not only the companies themselves but also the broader financial markets. How hedge fund activism affects corporate governance. One of the most significant impacts of hedge fund activism is on corporate governance. Activist hedge funds often push for greater transparency and accountability within organizations, leading to improved governance practices. For instance, companies may adopt more rigorous reporting standards, enhance their communication with shareholders, or adjust their board structures based on activist demands. This push for better governance can be beneficial, as it encourages companies to operate more efficiently and transparently. However, it can also lead to disruptions, as boards may feel pressured to act quickly to appease activist demands. This competitive atmosphere forces boards to take shareholder interests more seriously, often resulting in positive changes. Financial performance and hedge fund activism. When it comes to financial performance, the results of hedge fund activism can be mixed. On one hand, some studies show that companies targeted by activists often experience immediate spikes in stock prices. This is typically a reflection of positive investor sentiment and the expectation of favorable changes. However, the long-term impact of these changes can vary. While some companies may see sustained improvements in performance, others might experience instability. For example, aggressive cost-cutting measures implemented at the behest of activists can temporarily inflate earnings but might harm innovation and employee morale in the long run. The effectiveness of hedge fund activism in enhancing financial performance depends on several factors, including the nature of the changes proposed, the company's industry, and the broader economic environment. The controversy surrounding hedge fund activism. While hedge fund activism can drive efficiency and improve governance, it can also spark controversy. Critics argue that activist funds often prioritize short-term gains over long-term growth, leading to decisions that may not be in the best interest of all stakeholders. This raises ethical questions about the influence of a few wealthy investors over publicly traded companies. For instance, critics often point out that hedge fund activists may push for strategies that boost share prices in the short term but undermine a company's long-term competitiveness. This approach can benefit shareholders in the immediate term but might not align with the interests of employees, customers, and other stakeholders. Moreover, the aggressive tactics used by some activist investors can lead to conflicts with company management, creating tension and potentially distracting from the company's core operations. It's crucial for activists and management to find a balance between short-term gains and long-term sustainability to ensure the company's continued success. The broader implications of hedge fund activism. The impact of hedge fund activism extends beyond mere numbers and financial metrics. It's about the long-term vision we have for the business landscape and how we balance shareholder interests with broader stakeholder concerns. As hedge fund activism continues to evolve, it raises important questions about corporate governance, ethical decision-making, and the role of investors in shaping the future of companies. In the end, hedge fund activism can be a powerful force for change, driving companies to be more accountable and transparent. However, it's essential for all parties involved to keep the long-term implications in mind and work towards solutions that benefit not only shareholders but also employees, customers, and society at large. So, what's the takeaway from today's discussion on hedge fund activism? It's clear that this form of activism has the potential to reshape corporate governance and financial performance in profound ways. By encouraging companies to be more accountable and responsive to shareholder interests, activists can drive positive change. However, it's crucial for both activists and management to maintain a long-term perspective and consider the broader implications of their actions. If you enjoyed today's discussion, be sure to hit that like button, subscribe for more insights, and let us know in the comments, what do you think about the role of hedge funds in corporate governance? Do you see them as a force for positive change or as a potential source of disruption? Thanks for watching Wealth Investopia. Stay informed, and we look forward to seeing you next time for more exciting discussions on finance and investment.